What's up, guys? Legendary value investor Seth Klarman just purchased a position in Facebook valued at $382 million. I love it when legendary value investors roll into a position after I've made mine. And guys, Facebook is up approximately 25% since we mentioned it on this channel. And so the fact that the stock is up, legendary value investors are getting into it, it's really weird for me to say that I don't think Facebook is worth entering into a position at these levels. I think at the current prices, the downside risk is way higher than I'm comfortable with. And guys, in this video, I'm gonna break it all down for you. And also, unlike other YouTubers, there is no paywall. I'm gonna give you a free to download model that I've built on Facebook that shows you how I got to my valuation. Download it, mess around with the inputs all you want, get to whatever valuation you think is fair, and tell me in the comments. You're watching More Money, let's get it. What's up, guys? Thanks so much for tuning in. You guys already know what it is. I'm Tay, 20-year veteran of the investment game. You're watching the #1 channel on YouTube for people that want to retire early. Before I jump into it, guys, please smash that like button. It really helps YouTube know that this channel provides valuable content. All right, let's get into it. Guys, it was just announced that Seth Klarman just increased his Facebook position to 41%, or $382 million, which reflects 3% of his portfolio, and is the 9th largest position that he holds. If you guys don't know who Seth Klarman is, no worries, I'll fill you in. He's a legendary investor and the author of the book Margin of Safety. He's the head portfolio manager of a hedge fund called Baupost Group. His book Margin of Safety is so coveted in the investment community that an original copy sells on Amazon for $2,500, or you can get it for $10 on Kindle. Now guys, as much as I respect Seth Klarman and I recognize that he's a seasoned value investor with light years more intelligence than I have, I personally think that his purchase of Facebook is a flight to safety for his portfolio, as opposed to an investment where you'd expect a multi-bagger type return. We are heading into a high inflationary environment, and companies like Facebook that have high amounts of cash flow are really good to put part of your portfolio in to protect your investments. Now, viewers of this channel already remember that we highlighted Facebook back when it was trading at $260 a share. If you missed that video, no worries, it's gonna pop up right now. Now, Facebook just reported Q1 earnings. I'm gonna quickly update you on those earnings and jump right into the valuation and go through the model with you guys. First quarter ad revenues are up 46% year over year. This reflects the strength of the reopenings and the entrepreneurial spirit as more and more people are putting money towards ad spend on the platform. As a result, Facebook's net income and EPS doubled year over year. Now guys, these results are not all rosy, okay? Hidden in the results is the fact that active users only increased by 8 to 15%, depending on the metric that you're looking at. So be careful here, because if this continues to show a sustainable slowdown, it may really impact the long-term growth expectations for this stock. Now remember, Facebook gets paid based on the number of eyeballs that are viewing the platform. Now, if that growth slows, absolutely the growth expectations for the company will eventually slow as well. Now, I'm not really worried, but of course, I'm gonna pay close attention to this because it could really change the story here. I think Facebook is still an extremely cheap medium of advertising, and more migration is expected to continue as the internet grows. Now, management has provided us with guidance for the rest of the year. Q2 is expected to blow out Q2 of 2020, mostly because Q2 of 2020, the spend was lower because it was the early stages of the pandemic. Q3 and Q4 are gonna grow somewhat at a lesser pace because Q3 and Q4 of 2020 was really high spending times. Now, Q3 and Q4 of 2021 are gonna grow at a lower sequential pace because there was higher spending in Q3 and Q4 of 2020. So overall, we have been guided to expect a blowout second quarter and more of a tapered growth for third and fourth quarter 2021. Now, one thing I really like to check with Facebook is how much cash and marketable securities do they have on their balance sheet. They are now sitting on $65 billion, which makes up approximately 7% of their market cap. Eventually, this excess cash needs to be paid out to investors, either by investing in their business, paying out dividends, or buying back shares. And you know what, guys? Facebook is buying back shares. They spent $4 billion in Q1 to buy back shares when personally I thought they were undervalued. So good on you for Facebook. We got some accretion with those share repurchases. I honestly expect the company to make larger purchases throughout the year. I would not be surprised if we ended 2021 with $16 to $20 billion of share buyback. They already have the cash to do it, and they're not utilizing that cash in any other way. Now that's it for the quarterly update. Now before I go into how I would trade the stock and show you the valuation and the model, if you received any benefit from this video so far, guys, smash that like button. It really helps YouTube know that this channel provides valuable content. Also, I'm going to tell you what the next video is. My next video is going to be on Rocket Mortgage. Yes, guys, I'm going to cover a meme stock. I've actually really liked Rocket Mortgage for a long time. I love their CEO and founder. I think Rocket Mortgage is the Geico of the mortgage space. So the question is this stock cheap enough to buy? Not only have I done a full analysis on the company, but I've also built a model which I'm going to give to you guys once again for free, similar to how I'm doing it on this Facebook video. So in order to not miss that video, guys, please subscribe to the channel and hit that notification bell to be notified when that video comes out. Now, all right, guys, we're going to jump into the model, but before I do, I just want to give you the conclusion now. I'm valuing Facebook at around $370 a share. This reflects a lowercase valuation of $240 a share and a best case valuation of around $585 a share. At the current share price of $316 a share, this gives us a potential downside risk of approximately 24% and an upside risk on our base case of only 16 or so percent. So I really don't think that there's a compelling entry point in here right now. I think when we purchased it at $260, that made a lot of sense, but north of $315, I don't think so, guys. I'm not going to be purchasing at these levels. However, you might have a different idea. Seth Klarman definitely had a different idea. So you let me know in the comments if there's a reason why we should be buying it, or if there's a way that I should be updating my model or adjusting it in a way that gives it a higher valuation. All right, let's jump into the model.
All right, guys, as promised, here is the model for Facebook that I've created. And once again, I will be giving you the link for this in the description of the video. So you'll be able to actually open this up. You'll be able to download it. And then when you download it, if you just click on File, Download, you'll be able to bring it into an Excel spreadsheet, or I think you should be able to open it up as a Google Docs as well. I haven't downloaded it myself yet, just because I've created these ones, but everyone that has been downloading them, they have been able to open them as Google Sheets as well. So either Excel or Google Sheets, whatever you're comfortable with. Okay, so the way that I've modeled out Facebook is, you can see here, everything's going to be in millions except for the per share numbers, and you'll see that this looks very similar to their income statement, which that's exactly what I'm going for here. So you got your revenues, your expenses, and then below you're going to see your net income, and then you'll see a valuation at the very bottom. So the way I like to do this is I modeled out the historicals from 2015 to the recent quarter that just came out. And then what I'm doing is a 5-year valuation. So what will Facebook look like as a company, or what do I think Facebook is going to look like 5 years from now? So that's kind of what we're doing here. I guess 4 years and 3 quarters from now, because we just passed Q1. So that's kind of what we're trying to do here. And then obviously, my personal preference or my personal belief with valuations is that if you spend time trying to come up with an exact valuation, you're going to become exactly wrong, and you're going to be exactly wrong all the time, because we just can't forecast. And I know that's an easy thing to say. So what I like to do is, when I value, I like to look at low case, the base case, which I think is the most realistic, and the best case. So low case, the company should absolutely deliver on the low case scenario. Now, if they don't deliver on the low case scenario, I would be suspicious of management unless I got a really good explanation. Like, things can happen, like I get that, but they should be able to trip over the low case. I would think, unless my estimates are unreasonable. So that's that. So anyways, the way Facebook operates is, it's an advertising business, and they operate in 4 locations. Now, Facebook does have other segments, like they do have the Oculus Rift or whatever, but the revenues for those segments are so low that I'm not even looking at them. Like, you're going to buy Facebook, you'll just get those divisions for free. That's the way I'm kind of thinking about it. It's so immaterial to the results right now. I mean, it could not be immaterial to the results going forward. I don't see I don't see a case for that. So leave it as it is. I mean, I've been to Best Buy. I've seen the Oculus for sale. I don't buy that. That's going to be a big part of the business going forward. That being said, their ad revenues, you got to break them off into the geographies that Facebook provides to you. I think that makes sense the way that they're disclosing it. So you got US and Canada, you got Europe, you have Asia Pacific, and you have the rest of the world. Now, You can forecast out the KPIs, which is the active number of users. You can definitely do that. But then you're going to also have to forecast out revenue per user and how the revenue per user is increasing. And like, you can get really complicated with how you model this. I totally get it. I kept it simple. And the reason is because, once again, I just kind of want to be approximately right as opposed to get it bang on. If I was modeling this for a company like back in my investment banking days, or I guess equity research days, I would be using the KPIs. But for the purposes of this, for the purposes of this, I'm not going to be building a model that I'm sending out to the buy side or whatever. So that being said, in US and Canada, I really think that the revenues are going to be they're going to be slowing down over time, especially over the next 5 years. Now, the average revenue growth over the last 4 years since 2016, 1, 2, 3, 4, yeah, has been 29%. So I guess the first question we got to ask is, do we expect Facebook to continue to grow in North America at a rate of 29%? We can very clearly see that they're slowing. If we were to just average out the last 3 years, you're closer to 24 or 25%. So it's very clear that they're slowing, and I think they're going to continue to slow. I think here's what's happening. I think you're going to see more ad spend on the platform per user, but you're going to see the number of users slow down. So the ad spend will mitigate the number of user growth that's happening. And so it'll end up growing at a rate that is somewhat slower than what Facebook has been experiencing. So where do I see this? Well, the average over the last 3 years has run around 24, 25%. I'm saying that the base case is probably going to be around 17.5%. Now, that doesn't mean that it'll be lower. That doesn't mean that it won't be higher. I'm just saying that that's kind of where I expect it to fall. Best case scenario, in line with where they are in the last 3 years. They can absolutely get this. And what Q1 is suggesting is they may very well have a lot of growth behind them, especially if they continue to target the small merchants, which I've kind of noticed that they are targeting. Like, I have a couple of small businesses and they have pages on Facebook, and Facebook's really aggressively targeting them to advertise. So we'll see how that goes. But over the or I guess over the midterm, I think 17.5 is reasonable. Europe, same story. I think Europe is growing at a slower pace in terms of number of active users per day, or whatever their active user metrics are. And so I would say that 17.5% a year over the next 5 years is reasonable. And that's going to be made up of revenue per user growth, and also more users actively using the platform. So I think these numbers are reasonable. You may not. You may want to bring these down. You may want to use the lowercase, or you may think, hey, you know what? Facebook is like Gary Vee always says, Facebook is a cheap platform to advertise on, especially if you know what you're doing. So more ad spending going onto the platform might get you closer to the best case. Okay, that being said, Asia Pacific, this is their fastest growing segment. As you can see, over the last 4 years, it's grown on an average of 45%. If you just take the last that wasn't the last 4 years. The last 4 years has grown on an average of 47%. And then even if you were just to take the last 2 years, because it seems like it's slower than 2017 and 2018, you're still looking at 30% annual growth. Once again, I actually think Asia is going to pick up. I don't think Asia is slowing down. That being said, I still am being somewhat conservative with my estimations. I actually think this is probably around 22. So I'm thinking, the base case is probably 40% of the average of the last 4 years, which was around 18%. I might even just subtract 2.8% out of that and give it around 16%. I think that's as low as it's probably going to be over the next 5 years. 22%, I think it's reasonable for the Asia and Pacific region, and then 30% obviously your high end. I think this might be a bit conservative, to be honest. because I really think that the Asia Pacific region can really pick up, especially when the dollars come onto the platform. I think the user growth is picking up. As I showed in the previous video, it's the dollar spend that really needs to pick up on the platform, and I think it's coming. I mean, they are showing that it's coming. Like, look how much it's grown. And I think it continues. Like, you went from a $4 billion revenue business to a $20 billion revenue business in 2020. So, 5-6 times growth right there. So they're delivering, guys. They're delivering. So I think 22% is reasonable. And then the rest of the world, this is a toss-up because the rest of the world is really Africa and the Middle East. And I think I need a little bit more guidance here, because it's kind of all over the place, right? You got huge growth here, and then you kind of slow down here, and then of course Q1 is through the roof again. So I don't know the direction that this goes. I know that there's a lot of growth here. I don't know how much, how fast their ad spend growth grows here. Their user growth is definitely there. It just comes down to what the ad spend is. So, I think 20% is reasonable. This probably should be in the same ballpark as Asia Pacific region, but it's not. In fact, I almost am comfortable taking this down to 18, just because, like I said, I don't know. And if there's a little bit of uncertainty, I always tend to side with the more conservative approach. Now, you might see the 18% and be like, that's too high as it is. So download the model, change the estimate if need be. 30% on the upside. I actually think I think Facebook has some tricks up their sleeve and they're able to deliver on the high end. However, I'm not going to invest based on the high end. I'm going to invest based on the base case, low case to base case type of thing. It's always good to look at blue skies, but companies always run into problems, and so I just want to be careful of that. Okay, so now with respect to the cost of the revenue, you can see that their cost over the last how many years? 1, 2, 3, 4, 6. Over the last 7 years. Maybe if I make this bigger for you guys. Yeah, and then I'll just make this smaller. So the cost over the last 7 years is approximated around 16%. And so I'm giving it a little bit more here. I'm forecasting it at 20%. So we can have some upside surprise here. There, over the next 5 years, they could trend on the cost of revenue being a lot lower here. So there's some upside surprise here. With the research and development, they generally seem to target 20% bang on. So I'm just forecasting 20%. With marketing and sales, once again, you can control this spend. They generally get to around 14%. That's kind of what I'm forecasting. With the G&A, I'm going a little bit higher here because there could be some continued litigation risk for the company, yada, 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 more platform cleansing, so to speak, because, they get accused for fake news, whatever. We all saw the what was it called, during COVID, we all saw whenever people made a post related to the vaccine, there was some technology that pick it up and give us a warning. So, I mean, building out those platforms and people to run it all costs money. And I think the scrutiny is going to be more on Facebook going forward. I think there's some potential swelling for this line going forward. And the swelling might get offset by the reduction in the cost here. So I think at the end of the day, we get to a nice total cost as a percentage of revenue in the 62% range. Now, if we look at the last 7 years, 6 years. Why am I saying 7? The last 6 years, you're noticing that it averaged around 59. So we might have 300 basis points here too much. So might be, once again, a little bit conservative here, but I'll leave it at that. I'd rather be on the downside. Now I'm ultra conservative, so you might want to make this a bit higher, but you can see in 2020 they actually hit 62%. So who knows? Anyways, so the interest and other income, this, the cash is going to stay on the balance sheet. So, or it looks like it's staying on the balance sheet, or it looks like there's a piece of the cash that's going to remain on the balance sheet. So they're probably going to be generating more interest, but I'll just leave that at 400. no rhyme or reason for this. It just I don't want to over forecast here because I'm going to build in accretion for the cash on the balance sheet in terms of share buybacks later in the model, as you'll see. Taxes, generally, they, I mean, let's not look at 2015. Generally, they are around 18%. Q1, they're providing for less than 18%. I'm going to go with 20% overall. So now here's the thing. You're going to have a pickup here. You're likely going to have a pickup here of a couple of basis points. That's why we saw that this was 300 basis points higher. You're probably going to have a pickup here too. So I might be a little bit too conservative. I might be 500 basis points too much here. So this net income could be much higher as a percentage of revenues. However, if you notice, I'm right on around 30%. So, the bottom line is, 30 cents to every dollar that they make goes right to their bottom line. This is a wonderful business, guys. This is a wonderful, wonderful business. And if you look at their average, they've averaged around 32%, 33%. So you can see right down to the bottom line, you're seeing that 300, 300, like 250, 300 basis point inefficiencies that I'm building in. Change it as you will. Now, where does the multiple stand by like right now? The multiple on future earnings, I think, is around 24 times. It might be higher, it might be around 25 times now that the share price has gone up. On previous years' earnings, it's around 27, I'd say 28. The multiple is going to come down, guys, as this company grows out. It's going to continue to slow in growth. International is going to be way more important to the business than domestic. So expect this multiple to come down. Also, we have just been, what's the word? We've been conditioned to expect higher multiples from technology names. We are going to enter a world where you're going to see lower multiples from technology names. Guys, the historical multiples of the market is just between 10 and 20 times earnings. I understand that a part of that is that we're getting higher multiples now because the interest rates are lower. I get that. But that being said, we're sort of entering into an environment where we're expecting more inflation, or at least we're starting to see the inflation that everyone was screaming about that we were getting historically, but we just haven't been measuring. I don't know how much I believe in that. But that being said, I've always forecast at 5% inflation rates, irrespective of what the actual inflation rates are. And I think most people have been doing that on the value investing side. It's just extra conservatism. So that being said, I like the 20 times multiple, another element of conservatism. So as you can see, just my base case is just, they're probably going to smash this out of the water in like 2 or 3 years. It's not going to take them 5 years. But that being said, I rather find huge value in something that I've built a conservative model on and invest in that than not building the conservatism. So be it as it may, this is why valuation is a bit of an art and a science. Okay, that being said, the market capitalization based on that multiple and the net income on the base case is around $1.2 trillion, guys. $1.2 trillion. That's crazy. Okay, so they have 2,800 shares. The Class B, a lot of people might not know, no matter how many shares you buy in Facebook, you will never control. You'll never really control the business. These Class B shares are pretty much owned by management, predominantly Zuckerberg. So the guy's gonna have control for the rest of his life on Facebook, or until he decides to give up these shares. I don't think he will. He's a young guy. You'll notice that over the next 5 years, I have not reduced the number of shares, even though they're buying back shares. And the reason for that is because I actually build in the accretion down here. So let's start with this. So this is my share price discounted at a rate of 5% for 5 years. So all I've done is I've taken this market cap, put it in the right, because remember, this is in millions, and then I divided by the number of shares. So I got to $341 a share. Now they have $44 billion in marketable securities, and they have $20 billion in cash. This is a cash flow business. They are generating cash hand over fist. I think all of this cash is excess. Look what I did here. I put an 80% factor on here. So I'm saying that 20% of the cash that they have on their balance sheet, they're probably need it for the business. Who knows? So 80% of the cash equals around $18 a share. So once again, a little bit of conservatism here. You can put that at 100%. I don't think it makes a huge difference. Like if I were to just put that at 100%, it might get to like $22. Okay, so an extra $4 a share. Who cares? Let's just be conservative. So I am valuing this company at $360 a share. I made some changes, of course, but $360 a share on my base case. My low end case is $233 a share. So based on its current share price, we got a 26% downside. Based on its current share price on the base case, we only have a 14% upside. And then, of course, if everything is blue skies, blah, 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 you're looking at almost a one bagger. 85.1%. So overall, I think that there's lots of downside risk here, limited upside. So I wouldn't be initiating a position at these levels. In fact, I'm going to be looking to reduce and pretty much eliminate my position in Facebook. I'm hesitant because I'm already like 60% in cash right now. It's just difficult to find opportunities. But that being said, I don't really want to hold something that has more downside risk to my base case valuation. What I really want to see is my downside risk to be a plus 50% and my upside risk to be in the baggers, like 200, 300, 400%. So Facebook is not that right now. I think Facebook is a flight to quality because, if the market goes kaput, I don't think this actually materializes. I think, it goes down 10, 15, 20, 10, 15% or so, but it will go down less than the overall market. It'll definitely go down less than the other names in the tech space. Okay. That being said, let's look at what the valuation was when we first talked about it on the channel. So it was $260 a share. Look at the upside to downside potential. So it was, technically the downside was only 10%. We had 4 times that on upside, so 40%. Still not phenomenal, but I really loved it. I have a bias for Facebook, so anytime I'm telling you not to buy Facebook, it really hurts my soul because I love this company. And then, of course, best case, you had a 1.25 bagger. And then, I wasn't on YouTube at the time, but when Zuckerberg was being grilled by the Congress in the U.S., the shares went really far down. And I remember I was just posting on my Facebook to anybody that would listen to me, guys, if you can, please look at these shares because they're severely undervalued. And now we see it, we materialized to around $316 a share. So just based on the valuations, at that time, I mean, obviously the valuations may have been different, but assuming we had hindsight and we came to the same valuations, you're looking at a 42% upside on the low case. So that's what I'm talking about when I'm looking at investments. That's kind of what I want to see. This is still not that high, but this would have been great. I would have put money into this for sure at 165 all day long. I'd be buying this thing, and then, a 2.5 bagger on the top end for a company as solid as Facebook. Nobody has a moat like this company, or very few companies have a moat like this company. So that's it for the valuation, guys. Please download the model at your discretion. Change whatever metrics that you want. Let me know what you guys are changing. I want to know what you're thinking. Is there something that I missed? Let me know. And of course, if you want to talk to me every month, please join the Patreon. We have a call every month. We go over, I don't know, maybe around 70 or 80 stocks that I'm tracking. And I'm sending these models out first to the Patreons anyways. I don't really believe in paywall, so if I cover the stock on the channel, I'll just release the model anyways. But just the Patreon guys, you just have access to everything, so just be that as it may. And of course, as I make the videos on the companies that I'm really following, I'm going to be posting the models along with them as well as I have the models. And like I said, the next one will be Rocket Mortgage. That model is pretty easy to make. I like the company. I think it has a really good moat. I think it's the Geico of the mortgage space. So let's take a look at the valuation. Let's see if it's worth anything or if it's worth buying, but we'll leave that at that. So guys, once again, thank you very much for checking out the channel, and I'll see you guys later.